Hello and welcome to today's exchange brought to you by the NYSE. I'm Douglas Jonas, your host. I'm joined today by my friend Nancy Davis. If you don't know Nancy, she's not just the founder and CIO of Quadratic Capital Management. She is also the portfolio manager for her ETF IVOL, IVOL. Nancy, thanks for joining us here today. As a reminder, today's interview is for informational purposes only. The NYSE does not recommend investments or investment strategies. Nancy, a lot of conversation these days around inflation, but I've actually heard you talk a little bit on the media about the idea of stagflation. Could you tell us what you're seeing out there?
I do think inflation has definitely become a topical theme, but I look around myself in everyday life, and it seems like a lot of these things are higher prices, but not necessarily growth. And that's because of the pandemic and shortages that we have with supply chains being broken. And to me, I look back at the 1970s, that was the last period we had stagflation, and it was really the oil embargo that caused it. Clearly, that's not happening now, but I do see the global chip crisis as potentially the new oil to cause potentially stagflation, because chips are used in everything, right? Electronics, appliances, cars, everything uses chips. And Intel's CEO has said that the chip crisis is gonna continue for 3 years, and so that could potentially be a stagflationary outcome where there are higher prices but actually lower growth.
So, in your opinion, are there ways investors should be thinking about protecting their portfolio, whether it be inflation or stagflation?
I definitely think stagflation would be the ultimate kiss of death for the traditional 60-40 portfolio, right? That would just be like, take it out back and beat it with a stick, because that is when stagflation is stocks and bonds selling off together. So all of the diversification benefits that we've really enjoyed for the last 30 plus years of, stocks go down, bonds go up, may not apply if we have a stagflationary environment.
So, when we do talk about the idea of inflation, are there metrics that you use on your side of the business to look at, to look for warnings or to measure inflation?
Well, I think the most common measure for inflation is the break-even market, which is implied from the difference between treasury bonds that are nominal versus inflation-protected treasuries. The problem with only using that metric, and that's actually not what the Fed uses, they tend to rely on PCE, the TIPS market is only the CPI inflation. And so CPI is a consumer price index, right? The ICE and the New York Stock Exchange, you guys are perfect counterparties to talk about the difference of having lots of indices and lots of, it's like saying if somebody had the Dow Jones, do they have equities? It's just one index. The CPI is a consumer price index. It's calculated by the Bureau of Labor Statistics, and about a third of the measure of CPI is what they call shelter. And I use air quotes because shelter is mostly owner-occupied rent. So to me, it's not the only way to think about inflation and inflation expectations. There are other ways to do it as well.
So Nancy, a lot of times I see you on television, you're talking about the rates market. Would you mind explaining for the viewers, why it is you focus on the rates market and how it might be important for us as investors?
So what I mean by the rates market is the interest rate markets. So even in the US dollar, there are lots of different types of interest rates, right? There's policy rates, there's Fed funds, there's LIBOR, there's OIS, there's Treasury, there's swaps. There are tons and tons of different interest rates. But to me, the interest rate markets are global, especially the OTC swaps market, because that's where corporates go to hedge their bond issuance in dollars. So it's a huge global market. It's relevant, I think, for most investors, whether they own real estate or whether they're invested in other types of the markets. Interest rates do matter. And I think the key point is not all interest rates are equal. When people think of interest rates, it's not just policy rates, it's what the term structure of interest rates look like, where lenders lend money at different periods of time.
Now, of course, a lot of people might not know you have your own ETF. Its ticker symbol is IVOL. It's the Quadratic Interest Rate Volatility and Inflation Hedge ETF. A lot of words in there, but I was hoping you could explain for everyone exactly how they should be thinking about IVOL when it comes to diversification in their portfolios.
So IVOL is an access fund. It accesses the rates market. We've partnered with the NYSE to list the product. So it was the first of its kind ETF. It listed in May 2019, and it is mostly treasuries. We use treasuries with inflation protection called TIPS. That's about 85% of the portfolio. And then we add interest rate options inside the portfolio to give access to inflation expectations not measured by the consumer price index. So it's a pretty unique fund because it uses, inflation is one of those things that can trade negative, right? It's not like buying a stock where it can only go to zero. Inflation can go into deflation. It doesn't have a zero bound. So we find using interest rate options is a very conservative way for us to gain access to inflation expectations, not measured by CPI, but also to have with the options piece defined downside in case inflation expectations fall.
Easy to remember, IVOL, IVOL. You can find this episode alongside a lot of other educational episodes at our website, homeofetfs.com. That's it for today's exchange with Nancy Davis. Again, homeofetfs.com, brought to you by the New York Stock Exchange, the home of ETFs.